let's take the discussion back to the U.S. markets and the way forward. Matt Orton, U.S. market strategist and the chief market strategist at Raymond James Investment, is now with us on the show. Great to have you back on the show. Thank you very much for joining in. Well, the big event today is going to be Jackson Hole. Investors are in wait and watch for any kind of guidance on future rate cuts. So first, if you could lay out your own expectations, and can it surprise the market? Because even if he does signal a rate cut is coming in the month of September, it's probably only going to confirm what the market is anticipating.
Hey, good morning, Reema. Great to see you again. And I think you're right. The market's probably going to get confirmation of what it already suspects is going to happen. It's essentially consensus that the Fed is going to cut rates at its September meeting. And the key question is, how much is Powell actually going to broadcast with respect to not only the scale of the rate cut, so is it going to be 25 or 50 basis points in September, but also is he going to give any clues as to the depth of the rate cutting cycle, both for this year and next year. And so market positioning as a whole still looks offsides to me. It's been my base case that the US economy is in better shape than a lot of people have thought. I think that's why we've seen the recovery over the past week or so, because the totality of the data, despite one or two weak prints here or there, it just doesn't signal the need for the Fed to step in and cut by more than 25 basis points, which would require serious revisions to the summary economic projection. So I think Powell's going to broadcast that that rate cuts are going to be coming. I don't think he's going to give too many clues, both either to the scale of what that cut's going to be or to the depth, because that's just not typically what Jackson Hole is for. So I don't think the market's going to get what it wants. If we get a little bit of volatility, I've been telling a lot of our clients, use that as an opportunity to continue putting capital to work in this market, but use it to build balanced portfolios. Lean into quality, because I think this elevated level of vol is probably here to stay through the fall, or at least until we get through elections.
Okay, Matt got that. Hi, good morning. So stick to quality. I think we're getting similar advice here in India as well, because volatility has become quite a companion in the last few weeks, right? So just tell us a bit in terms of looking at positions beyond the US. We also have obviously the whole question in Japan about whether the whole carry trade issue is behind us or not. I mean, I was looking at data out of Japan as well, the inflation numbers that came out. What's your sense? I mean, for every additional $100 you have to invest, how much would go to the US? How much would go elsewhere? And how much would you put to work in India?
Yeah, it's a great question, Surabhi, and it's one that a lot of clients are asking too, is just, if I'm going to put money to work, where is it going to go? I would say the US is still the top place I would be allocating dollars, just because I think the economic story is clear, liquidity is very good. There's still a lot of good places to put money to work, given where earnings growth is broadening and the fact that the average stock in the overall market just hasn't performed anywhere near what the fundamentals should be suggesting. But I think there's also opportunities, countries like Japan, which have been an overweight for me this year. It certainly was painful for the past couple of weeks with the drawdown, but the fundamental story that is there hasn't really changed. I think Japan, knowing what you own and that quality bias is going to be really, really important. Maybe you don't own as many banks because the BOJ is not going to hike rates as quickly or as much as I think some investors may have been expecting. But the fundamentals of the Tokyo Stock Exchange, basically having companies that are low valuations, implement shareholder reforms, more equity ownership by domestic investors, that's still a positive tailwind. So, $60 goes to the US, $30 probably goes to Japan. And then the rest of that, I think India is certainly still a very, very appealing place. I mean, when you're looking at a global economy that's normalizing, starting to slow down, that's not the case in India. And I know a lot of clients complain about valuations in India in general, but I think the growth justifies it. And earnings growth is growing at 16, 19, 20% in India, which is almost double that of what you're getting in the US. So I think there's some very clear fundamental stories that exist in India that justify valuations. So it's still very, very attractive to me. And it's very under-owned by overseas investors.
All right. Hi, Matt. Always good to hear your thoughts. You're clearly sounding very bullish on India. And fundamentally, there are a lot of stocks as well that are well placed here, particularly the large cap names. In the past, you've spoken about stocks like ICICI Bank, Coal India, Mahindra & Mahindra. What's the top 2-3 bets you're taking here in India?
So I think given the pullback that we've seen in Mahindra & Mahindra, I think it's a decent time to reload or put some money to work if you feel like you've missed it. I think the launch of Thar Rocks is certainly attractive, and I think just the volume gains they plan to get through the whole lineup looks good. You know, I know passenger vehicles overall is not really the hot place to be in the Indian market right now, but I think their market share coupled with the farm implements business gaining market share in the tractor segment, that's very attractive. It's accretive to earnings, and I think they've continued to surprise to the upside. So definitely a name that I would be using weakness opportunistically. I think as well a name that's fallen that also looks attractive right now is Hindustan Aeronautics. You know, the global defense theme is one that applies. I like defense companies everywhere around the world, but Hindustan, I think, is particularly well positioned, just given the modernization that's happening in India, the fact that they're trying to go both with the domestic market and increasing exports, and they've delivered on the earnings front and on the margin front. So to me, I think using that downside looks attractive right now too. So definitely a good opportunity there.
Okay, so Matt, just a quick last word. You said most of the capital, a majority of it will still go to the United States. India looks appealing. Japan is still attractive, barring the banks. But say for the next 2 or 3 months, because now we're entering into a regime shift with lower interest rates coming in from the US market. So from a 2 to 3 year point of view, with the entire shift in the investing landscape, with the macro backdrop changing, how would you approach? Would it still be the same allocation to equity classes that you earlier highlighted?
Yeah, you know, Reema, that is a fantastic question because it's something I was actually just having a conversation with a client with yesterday. And this goes to the fact of why I think emerging markets can be more attractive and over the longer term, why I think India is a strong beneficiary of that change, because as rates come down in the US, as the dollar weakens a little bit more, emerging markets become more attractive. And we're at 10-year lows with respect to EM allocations across global funds. So if you extrapolate that and you start to see just a little bit of an increase with the decreased weight of China in EM indices, increasing weight of India due to strong fundamental performance, the math adds up that India just becomes even more attractive as that shift starts to happen. So, you know, if you're looking for growth and you're looking to play the long-term game with respect to regime shift around the world, India is still incredibly well positioned within the emerging market complex.
Okay, all right. Good to hear that, Matt. Thank you for joining in, and I wish you a good rest of the, well, yeah, it's night for you, and then a good Friday and a good weekend. All right, thank you so much for being with us. Let's